Hello everybody, we are back, Accounting 1101 with Solid Footing Chapter 4 Part 2. Part 2 of a two-part video. If you didn't take a look at Part 1, I suggest that you close out what we're doing here, go back and check out Part 1 before we get into Part 2 here. In Part 1, we talked about a new account called retained earnings, the profits and earnings that a business has kept and hasn't spent yet. And we have an account for that. It lives under the owner's equity, part of the accounting equation. We talked all about that one. And we introduced the concept of revenue and expense accounts. If you didn't pick up on that, again, go back to video 1 and check that out. And we also introduced the idea of an account receivable. When a customer comes in, they buy, but they don't pay in cash right away. They kind of give an IOU, and we allow them to do that. And we expect to receive that payment later on. So pretty big concept that we went through there in Chapter 4, Part 1. We're going to build upon that in our video here right now. We had a ledger that we were kind of keeping, a general ledger as we went along, and here is where we stand right now. You can see the balances in all the different accounts that we have going on, and we left our video in Chapter 1 right here saying, man, we've sold out. We have no more inventory. And I mentioned that we're going to have to buy more inventory so we could sell more stuff. So that's where we're at right now. We're beginning transaction number 5 where we buy inventory. So here we go. We're at February 11th and Gray Company buys more inventory. We paid $7,500 for the inventory and we paid with cash. So we've got to make an entry for that. On February 11th, bought more inventory. I'm going to put 211. And just a reminder, you can print off our notes here and kind of pencil in as we follow along. That way your notes will be completed. But we bought inventory. We paid for it with cash. If you look, both of those accounts are on the asset side of the accounting equation on the left-hand side. That means they go up on the debit or left-hand side, and they go down on the credit side. One account is going to go up. We're getting inventory. Cash is going to go down because we had to pay cash in order to get the inventory. $7,500. So here comes our inventory. $7,500. Cash goes down. And we'll post it to the ledger accounts. $7,500. Just like that. And again, to reiterate, when we post it from our journal over to the ledger, it keeps the exact same format. If we debit inventory, when we post it, we debit inventory down there too. We don't flip it. Now we have a total of $7,500 in inventory. And now we're down to $5,800 in our cash account. All we did in that transaction, we traded one asset for another. So that entire transaction happened on the asset side of the accounting equation. But our debits and our credits equal in dollar amount, don't they? So that's totally fine. Transaction number 6, it comes time, we move 2 weeks into the future, and now the employees need to be paid again. So we pay our employees on February 26th $900 in order to pay them for the last couple of work weeks that they did. 226, we paid $900, and that's going to be an expense. Our employees worked, so we have the expense of them working. Our wages expense, remember our expenses are almost always going to be debits. Only time they're not is if we're fixing an item that we boogered up or we're closing it out. So that $900 that they've earned, I'm going to record that. And we're going to pay them in cash. Remember, every transaction, we've got to analyze what accounts are in play here. We've got to figure that out. That's the hard part. Usually the numbers are just given to us. You have to calculate a whole lot. At least in principles of accounting, that's the way it is. In intermediate accounting, sometimes we have to do a lot of calculations to get a number. But for the most part in here, you just get the number. Wages, $900. cash. So now we're down to $4,900 in that cash account. And like I mentioned in video 1, the reason we have all these different expense accounts is so we can keep track of the different expenses. I can't manage it if I don't track it. So I would have no way of knowing what my wages expenses were in total if I just threw them all into retained earnings. Okay? So that's why we have these different expense accounts down there. Transaction number 7. You recall that we sold earlier to a customer and told them they could pay later on. That's an account receivable. When we sell to a customer and tell them, hey, it's cool, you can give us an IOU, we'll pay you later, or we'll get your money later on. That's called an account receivable. Well, now fast forward, and that customer has come along to pay part of what they owed. We sold $4,500 worth of stuff to them. They paid or owed $4,500. Now they're coming along and paying $1,500 of what they owe on February 27th. So break that transaction down. We have a customer coming in and paying part of what they owe. We know we're getting money, and we know part of what they owe is going to go away because they don't owe what they just paid for. So 227, customer comes in and pays back $1,500 of the $4,500 they owe. There's that $4,500 they owe. Remember, asset side, we're going up on the debit, down on the credit side. All right? They're bringing money to us to the tune of $1,500. So our money, our cash account needs to go up. $1,500. Boom, right there, just like that. They no longer owe that $1,500. So we got to take away from the account receivable. Paid us back part of what they owed. They don't have to maybe pay the whole thing off at one time. They obviously didn't right here. $1,500 and $1,500. So cash goes up $1,500. And our account receivable goes down $1,500. So at that point in time, that customer only owes $3,000 after that payment, right? We don't do anything to sales revenue right there. You might think, oh, the customer's bringing me some money, I'm going to count a sale. No. We don't want to do that. We counted what we sold when we originally recorded that account receivable. If I count sales revenue again, I'm double counting revenue. And we have a fancy little term for that in accounting. It's called fraud. And you don't want to be the fraudulent accountant, because that's kind of how you end up in jail as an accountant, if you become the fraudulent accountant. I am raising you all to be ethical accountants. Ethics are important. We don't want to double count revenue. We're just collecting money that we were owed. Not a sale, collecting money that we're owed. So now we got $6,400 in total after I record that into the ledger and add it all up. Notice I'm adding up the positive, subtracting out the negative side, and I get my balance. Okay? And down to $3,000 owed from customers. $4,500, customer paid back $15,000, $3,000. I've got $7,500 in inventory. Nothing in that transaction to do with inventory. We just collected money we were owed. And we're ready to go. Finally, transaction number 8. We are down to the final transaction of the month. It says on January 5th, Gray Company borrowed $8,000 from the bank. You did that transaction in Chapter 2. We did the month of January in Chapter 2. And you can see right here, there it is. The $8,000 we borrowed from the bank is already in there at the beginning of February. The bank said, hey, you don't need to pay us any interest in January. We'll waive it. Just ignore it. But come February, you're going to be billed for the interest on the loan. You don't have to pay it until March, but you owe it for February. So you see what's happening here? We borrowed money. No interest in January. Don't worry about it. February will bill you. You can pay us in March. Well, we need to record the fact that February, we incurred an expense. We incurred interest. Even though we don't have to pay it for a month, it still happened in February. Very important in accounting. We want to match up our revenue when we get it with our expenses, when they happen. If an expense happens in February, we need to record it, even if we don't pay it until later on. So we owe $40 in interest. So at the end of the month, $228. I'm going to make a little adjusting entry here for $40 that we owe in interest. Boom. $40. Well, what accounts are we talking about? Well, we had that expense happen in February. So we have an account called interest expense. We owe that money. We haven't paid it yet. It's a payable. We got to pay it at some point. So that'll be our credit. Interest payable. Remember your expenses? Always debits when we record them. That payable account lives on the right-hand side of the equation, so it goes up on the credit side. We recorded the fact that we incurred that expense in February, but we haven't paid it yet. Very important to match up your expenses in the month they happen so we can keep an accurate track of our profit. All right? Now, another thing I want to point out. Interest expense, interest payable. It is so important in accounting that you use a complete account title. What'll happen is some people want to get lazy on me, and they'll just want to say, maybe they'll just want to put interest in for the account. Well, wait a second. Is it interest expense? Is it interest payable? Is it interest receivable? Is it interest revenue? You have to put the entire account title. Don't get lazy on me and just put one word. Put the entire thing. Interest expense shows that we had an expense that month, and the payable shows we haven't paid it yet. We owe it. A little bit confusing. We have 2 entire chapters dealing with entries like that later on. So put it all together, we have a thing called the accounting cycle. That was our final transaction in the month of February for our example company. So you put all this stuff together. You analyze the transaction. You think about, what accounts are in play here? Then you journalize it. You make a journal entry. Then you post it over to the general ledger account. And then you calculate the ending balances of every account. That's kind of where we're at right now. When you do all that, you can start to do your reports after you do your trial balance and make sure everything balances. Then you can make your financial statements. Okay? So we're right here at this part. We made all our entries. We've analyzed them. We journalized them. We posted them. Now we're going to calculate the ending balances. And it's already kind of done for you here because you're keeping a running tab in Excel, the solid footing spreadsheet does. So really what's happening again, to calculate these ending balances, I add up the positive side, I subtract out the negative, and I'm just putting one number, the ending balance. Some people will add up this side, put the number, add up that side, put the number, and that's not what we want. We just want one ending balance on the positive side. So all my ending balances, add up the positive, subtract out the negative side. Add up the positive, subtract out the negative, and I get an ending balance in every account. And I have to do that for every account. Add up the positive side. Boom. Add up the positive side. We also call that the normal balance side. You may hear me say that sometimes. The normal balance side is the side it goes up on, whatever account we're talking about. So we got all these ending balances. We're ready to go to try to do the trial balance and make sure everything balances out. So let's bring up a trial balance here. So here's our trial balance, and I've got it labeled for you already. The trial balance is going to have every single account in the accounting system listed out. And what we're going to do is we're going to put the ending balance in from every single account and try to make sure that our debits and credits equal. It's important that we put it on the correct side. Whatever side the balance is living on is the side that comes in on the trial balance. Okay? So what I'm going to do, I'm just going to take the numbers right here off my trial balance and plug them into the trial balance here. The general ledger balances, and plug them into the trial balance. So I'm going to pause and go ahead and fill this out, and you can do the same, and then you can check your numbers against mine. So I'm going to go ahead and fill this out, check and see if you come up with the same. Take your numbers right off of these ledger account balances. All right. So I've gone through and I've written out the ending balance on every account. Took it right from my ledger, kept it on the same side that appears on in the ledger, and I've got all these numbers in here. And I'm just going to add up the column for the debits. And I go through and I add up all these numbers. I already did. We get 31,540. 31,540. If we go through and we add up the credit side, we get 31,540. And again, the idea of the trial balance is that we want to make sure our debits and credits are equal, because that tells us our accounting system is in balance. If we don't equal right here, we've boogered something up. We got to go back and look for it and fix it. So if your trial balance doesn't balance, you got to stop. And you got to go back and you got to fix it. The accounting, to make sure that your ending balances and the ledger accounts are correct and the transactions have been done correctly. So the other thing I want to point out on our little trial balance here, notice it says pre-closing. We talk about closing in chapter 5, and then we do a post-closing trial balance. So this is kind of one of two trial balances we do. We do one before we close everything out on the income statement side. We do one after we close everything out. So that's the trial balance. We do that to make sure the accounting system is in balance. Accounting harmony, as I like to call it. So now we got a new financial statement. We have an income statement. We had a balance sheet that shows what we owed and owned. Okay? What we owned and who had a claim to it. Assets, liability, owner's equity. We had the balance sheet. Now we have a financial statement that shows us how much money we made. Pretty important. Income statement. How much money did we make during the period? We're just going to take our numbers right off our trial balance here. And what we're trying to do is look at revenue minus expenses. That's profit, right? Just like we learned about in video 1 of chapter 4 here. Revenue minus expenses is profit, or loss if we have more expenses than revenue. So that's all our income statement is, gang. Revenue minus your expenses. So again, we pull that right off the trial balance. Our revenue, 13,500. We're just going to write it right in here. We're going to subtract from that revenue our cost of goods sold. We're subtracting that out. What did we pay for the inventory that we sold? Well, cost of goods sold, 7,000. We're subtracting that out, minus 7,000. Our gross profit, 6,500. Gross profit is a measure of how much money we made just buying and selling the inventory. What we sold the inventory for, what we paid for it. Gross profit. Really important number for a retailer or a merchandiser, because we have to pay all our other expenses out of that gross profit and still hopefully make money. All right? So if that's a negative, if gross profit's a negative, that means that we're paying more for what we're selling than we can even sell it for. Well, that's not good business at all, right? So what we sold, revenue is always going to be the top line. You hear that sometimes in business. Our top line is revenue, always on the income statement. We subtract out cost of goods sold, what we paid for the product that we sold, we get gross profit. Then we're just going to list all our other expenses here. We had wages expense, 1,900. We had rent expense, 700. We had interest of 40. We're going to add those together. 19 and 7, 2,600, and then another 40. Total expenses, 2,640. All right. Gross profit minus our total expenses there would give us our net income. So 6,500 minus 2,640 gives me 3,860. That's my net income. 3,860. So during the month of February, Gray Company made a profit, 3,860. You'll notice the little double underline here. That means that's a final and total number. That's the final number, 3,860. net income. We made a profit. Good job, great company. The income statement tells us how we got to that profit. Revenue minus expenses. And I feel like I'm beating a dead horse here with an accounting stick, but the reality is income statement is super important. You need to know how to read it. You need to know how it comes together, because that's the financial statement that tells us how much money a business made. And whether we're talking about Walmart, Netflix, Target, Disney, whatever the case might be, great big huge corporation or a small business, in Hillsboro, Ohio. Income statement. How much money did we make in profit? So we did the income statement. The next step is to figure out retained earnings and how retained earnings went up or down during the period. All right, we said retained earnings is the earnings and profit that we have retained. So we're going to add our income to retained earnings. So this is how we calculate that. Calculation of retained earnings as of February 28th for the balance sheet. All right. This isn't a financial statement. It's just a calculation. We began retained earnings had a zero balance right there. See it? Zero. New business. We hadn't sold anything yet. We haven't had any profit or loss yet. So we began with zero. So that's where we're going to start. Oh, we got clicks going out of control here. There we go. Retained earnings. Beginning balance, a big fat goose egg. Zero. Nothing. We had no retained earnings. New business. Then we're going to add to that the net income for the month. If we had a loss, it'd be a subtraction. We'd subtract from retained earnings balance. But we're going to add to it because we had a $3,860 net income for the month. $3,860. Zero plus $3,860 tells me my retained earnings at the end of the month, $3,860. So again, net income will go into retained earnings. I'll show you the journal entries to make that happen in Chapter 5. But now I just want you to be aware that that net income, that profit, adds to retained earnings. It's profits that we haven't expensed yet. We need that number right there so we can do the balance sheet, because that balance sheet has retained earnings on it. So here we go. Here's my balance sheet. We start right here. This is step one with that pre-closing trial balance. We got to do that and make sure we're in balance. We are. So now we can do step two, the income statement. We did that. Then we calculate retained earnings balance. We did that. Now, finally, step four, the final financial statement we're going to do, the balance sheet. I got to do them in that order. I got to make sure we balance on the trial balance. I got to calculate that net income that we made. I got to calculate retained earnings. Now I can do the balance sheet. What we own and who has a claim to it. And remember, that balance sheet is simply a statement that shows us the accounting equation. Assets equal liability plus equity. Okay? We're going to pull the numbers right off the trial balance here. And we've already taken care of a lot of these. Put them on a financial statement. And those all went on the income statement. Now we have to do the balance sheet. So cash amount, $6,400. Just pulling them right off my trial balance here. All kinds of happy accounts going to their home. Every account has a home, y'all. And it either lives on the balance sheet or it lives on the income statement. It's not a shady deal where they have two families. You know, there's some other people that have two families. And the coronavirus and the quarantine really threw them for a loop. You know, you can't maintain two different secret families when you're quarantined at home. It's the same idea here in accounting. You have one home. You can't have two different homes. You either live on the balance sheet or you live in the income statement. So equipment, $5,000. There we go. Those are my assets. 64, 3,000, 7,500, 5,000 for cash, account receivable, inventory, and equipment. We're going to add them up. So let's get out the handy 10 key here. You can't be an accountant without having a nerdy 10 key calculator somewhere. And then 5,000. So I get 21,900 when I add those together. Total assets, 21,900. Note payable. Over here, 8,000. Interest payable, 40. Total liabilities, I don't even need a calculator for that. I'm going to do that all by myself in my head, 8,040. Common stock, 10,000. And now here's the tricky part. You look at that pre-closing trial balance, it says 0 for retained earnings. But wait, we did a calculation to figure out the new retained earnings. That was retained earnings at the beginning of February. We had net income for February, so now retained earnings, 3,860. I'll plug that in there. So total equity, adding up common stock, retained earnings, 13,860. Our equity comes from two places. Amounts that the owners and investors have contributed to the business, and what the business has earned in profit over time that has been held by the company and not spent. Okay? Total liabilities and equity. I'm going to add those together, and hopefully, if the accounting gods are here with us and are smiling upon us today, we should get 21,900, and we do. 21,900. Assets equal liabilities plus equity. Just like that. It's as simple as that. It seems so easy when I go through it. But when you go through it on your own, you may have a little bit of difficulty until you practice it and get used to what's going on. So as we're going through, you do your homework. If you can't get your financial statements to bounce on the first try, I don't want you to feel like a failure. Okay? It just takes a little bit of practice. And the other thing I want to reemphasize here, when you look at these accounts have one home, either on the balance sheet or the income statement. Okay? You'll notice I don't have cash on both of them. You notice revenue's not on both of them. It's in one place, either here or there. All right, so looking ahead, we did an entire month of accounting for Gray Company. All right, we did the entire month of February. So we've done January, where we bought inventory, we bought equipment, we got everything set up, and then February, we opened the door to customers, and we began selling, and we began paying our expenses. In the next chapter, Chapter 5, I'm going to show you how to reset the scoreboard. That income statement, I'm going to show you how to reset all these accounts back to 0 so we can play another game. We can play another month and track what we make in the month of March. That process is called closing. So that's where we're going in Chapter 5. But first, we have to finish up Chapter 4. I would like you to finish and submit your Chapter 4 homework. I'll take a look at it. I'll give you feedback on what you got going on, good or bad, on that, and we'll keep plugging away and adding to our accounting knowledge. And I mentioned this in video 1. I just want to reiterate it once more. Chapters 1 through 4 in Solid Footing are the accounting foundation. It's so critical that we understand what's going on in chapters 1 through 4. So I'm kind of leaning on you all to be honest with yourself and be honest with me. All right. If you need help, we need to talk. Don't just say, well, I'll figure it out later on. Because if you don't have it down in chapters 1 through 4, it's very hard to make that light bulb and have that epiphany aha moment in chapter 9 of Solid Footing. All right. Because it just adds on and adds on to itself. So I've given you the foundation and the basis. Make sure that you have it down. If you don't, I want to talk to you and we'll work it out hopefully together. So we'll see you back here for Chapter 5. Good luck on Chapter 4 homework, and we'll keep plowing ahead.